Wage growth for workers is slowing in the U.S. economy, but there's one group that's seeing record pay, and that is C-suite executive salaries. At some of the biggest companies, they continue to move higher. Karina Mitchell has more.
It's not just the guy in the corner office who is creating the value behind these big companies.
Despite that, the salaries of C-suite leaders at America's largest businesses keeps ballooning. In 2022, median compensation for chief executives hit $14.8 million. That was an increase of just under 1% from 2021, according to data from the Associated Press and Equilar, a California firm that tracks CEO salaries. Meanwhile, rank-and-file workers who've been making more than they have in decades amid a tight labor market are still trying to earn wages that outpace inflation. Some policy analysts say today's eye-watering CEO pay packages are unwarranted.
There's no argument that top CEOs today are any more brilliant or innovative than they were decades ago when the gaps between CEO and worker pay were much more modest.
The highest paid executive in 2022 was Alphabet's Sundar Pichai. He received almost $225 million in total compensation. Compare that to the median worker pay there, about $279,000. That's more than 800 times less than the top boss. Exorbitant salaries at the top have led to labor unrest. Even some institutional investors are now balking at the level of jaw-dropping compensation packages compared to what everyone else makes.
And that's why we are seeing more pushback, more unionization drives at many high-profile companies, and a little bit of change at the policy level as well.
Meanwhile, Lillian Dutra, who specializes in helping women return to the workforce after being away, says even at the top, female executives are being left behind.
It's a huge challenge to get a woman into the C-suite.
Both she and Anderson say more companies need to pay attention to the extreme inequity and make adjustments.
I think every company should look at a candidate based on their qualifications, their education, and how they can make a change in the company versus looking at a candidate at their gender.
Those are gaps that are bad for business and bad for our broader economy.
Karina Mitchell, CGTN, New York.
For more on the pay gap between CEOs and the rest of us, Laila Maidan, she's an investing correspondent for Business Insider. Thanks for talking about this on a Friday. This is more of a Monday topic, but we're gonna see what we do here, Laila. What's wrong with CEOs making a lot of money, and what defines a lot of money?
Well, a lot of money can vary from industry to industry. For example, when we look at the CEO median worker pay ratio, it's a good number for us to go off of, but it doesn't tell us the full story because depending on the company or the firm, that ratio can be higher or lower. For example, an investment bank's ratio is going to be lower because bankers are generally paid more in salary than a lot of other jobs. And then you can compare that to a company like, let's say, one that's in the food industry. That ratio is going to be substantially higher because you have different type of job titles there that have different salary levels. So starting with that number is a good point. Where that becomes a problem is I guess you can say the reasoning behind why a CEO is receiving such a large package. If a company, Phillip, is in a growth stage, a lot of CEOs are incentivized through packages that include stock options so that they have a little more skin in the game.
Well, okay.
And the reasoning behind that is that they'll grow the company and they'll grow it for everyone else. But let me finish here. Where it starts to become problematic is when you see these large packages coming in where it hurts company morale or where there's no reason for it. And that's why we have ESG investing, in which large institutional investors do take this stuff into consideration. But unfortunately, they're not really putting the emphasis that they need to on it because we still see these Fortune 500 companies with these huge gaps.
But okay, so if you and I worked for, let's just say, Google or Amazon, and you named a tech company and we were given a bunch of stock options, I would want the company to hire the most capable person, whoever they may be, that would most likely put the company on the right footing, as you alerted earlier. Let's just say the CEO ends up making $1 billion, but we benefit from that. It's in our interest, is it not, to have the best person run the company at the C-suite level, regardless of how much they're paid. Why should I care, or you care, what the CEO makes?
Well, it depends on the company, right? So if you have a CEO with a massive compensation package and they're laying off 6% of their workforce, or they have a lot of employees that aren't earning a livable wage, then that hurts morale. I'll tell you one thing, there are certain specialized funds out there that aren't investing in the biggest Fortune 500 companies. They're looking for small companies that have small market shares, like 5% in a major market. And they're looking for these companies that have the potential to take 25% market share in the next 10 years. What are these fund managers looking at? Well, they do look at things like the balance sheet. They do look at the management team and whether they're capable of growing this company, but they also really heavily look at the company culture and the employees and how these employees are working and being treated at these companies. That matters. I mean, Phillip, you and I know the millennial generation, the Gen Z generation, they're tough to keep around for longer than a year or two if they're not happy at a job, you know?
All right, I know we love our jobs, for the record, but by the way, now, here's my thing, though. If a CEO is doing well, and the company is growing, and they're getting more customers, and we're employing more people, and we're helping the economy, everyone seems to be happy. I think where the problem comes in is when you take some of these banks, for example, you take Silicon Valley Bank, you name the institution where things go wrong. And when CEOs get a big payout somehow on the back end, you know, the parachute, as they call it, people get angry because they see the workers lose their jobs, they see the layoffs, but they see the CEO taking a 20 or 30 or $40 million pay package because it was in their contract. Is there a way to make things a little more fair when the company either fails or doesn't do as well as expected?
Well, these are things that can be considered, you know, at the institutional level where they have discussions at the table when they consider ESG, environmental, social governance factors within a company. You know, shareholders think about this stuff and they talk about CEO compensation package and whether it's warranted to have certain packages. And so as you and I talk about this issue, Phillip, and we bring it up as the AP publishes an article like that, we're bringing attention to this issue and getting mega pension funds and institutional investors to start thinking about this more deeply and perhaps take these things into consideration, because shareholders do have a vote, and while they may not be able to veto a decision, they do have an impact.
Well, one thing's for sure is the movement on ESG and fund investing has certainly had a big influence on at least how companies manage themselves, and hopefully, you're right, it also has a positive impact on how they deal with compensation, especially at the C-suite level. Laila, I really appreciate your analysis on this. Have a good weekend.